Our team recently published our annual outlook, and we titled it Against All Odds, and I think that encapsulates 2023 very well. Going into the year, economists expected a 50% chance of a recession over the next 12 months, for example. And of course, we blew right through those expectations. The economy grew, the labor market remained strong, and as a result, the S&P 500 increased 26%. Bonds returned 5.5%, all on the back of more than 500 basis points of interest rate hikes by the Federal Reserve in the preceding 12 months. So the economy in 2023 proved resilient, stable, and really defied the odds that were laid out at the beginning of the year. And that supported capital markets as we ended the year and come into 2024. Going into 2024, our team is considering, as we mentioned, economic stability, what interest rates do, how inflation holds. Does that continue to cool? But as we look at asset prices and investment opportunities, U.S. equities seemed fairly valued coming into this year. Bond prices are fair, but interest rates have presented a unique opportunity for fixed income that we haven't seen in a long time. So as a result of the increased interest rate environment that we're in now, coming off of the near zero interest rate landscape that we have become accustomed to over the past decade, our team is seeing ample opportunities for investment portfolios today. So we're excited about 2024 from that respect, but we're also entering the year with caution as we manage portfolios, given those reasons of a fairly valued equity market, potential instability in interest rates, and the unknown with geopolitics and inflation. Going into 2024, our team is looking at the economic stability, continued cooling for inflation, what interest rates ultimately do, and how strong the economy proves to be. Going into 2023, the odds of a recession across Wall Street were 50%. Coming into 2024, leading economists have that probability now at 15%. So really the theme this year economically has been all but certain an economic soft landing, where economic growth slows, but we avoid a recession. And that is great for capital markets, as we saw last year. Coming into 2024, most market participants are already pricing in rate cuts throughout this year. As economic stability proved resilient last year and inflation continued to cool from the peak of 9% in June 2022 to December of last year at 3.4%, what the Federal Reserve is doing with rate hikes and slowing inflation, it's working. As a result, they've paused their interest rate hiking cycle, and now markets expect rates to be lower by the end of 2024. The Federal Reserve itself shares this sentiment. In December, their published summary of economic projections projected a median Fed funds rate of 4.6% by the end of 2024. Given that the current rate range is 5.25% to 5.5%, this implies multiple rate cuts throughout this year. Some economists expect rate cuts this year as early as March. AI, or artificial intelligence, another theme that our investment team is keeping an eye on this year, really began to make headlines over a year ago, and that really drove price returns in a lot of the companies that had exposure to the new technology or talked about it, in their earnings calls. Moving forward into 2024, we're looking at how is AI evolving, how is it continuing to develop, and how is it being integrated into company earnings ultimately, which is what investors care about. So I think that'll unfold, and I think the true implications, long-term implications of AI will continue to materialize more in a more solid manner throughout this year, which is what ultimately impacts investment portfolios, primarily in the equity markets. Geopolitics is always important. It's the one theme that always makes headlines, and over the long term, it's not been all that important in investment portfolios and long-term returns. But this year is certainly a more relevant topic and a more relevant risk to capital markets, as 40% of the global population goes to the voting booth this year, certainly in the United States as well, which we will all be focused on. The results of that election aren't what necessarily drive capital markets or capital market movements, but the uncertainty going into that election period is what generally drives capital markets to be more volatile. Investment returns generally are a result of the stability, of the uncertainty, and that uncertainty creates more volatility within investment portfolios. So that's something we're keeping an eye on. Of course, that volatility creates opportunities for us. As legendary investor Howard Marks puts it, we don't believe in forecasts, especially not our own. Instead, our investment team focuses on the facts of today. We study a lot of history, and we spend our time diligently focused on thoughtful asset allocation, prudent risk management, and careful security selection, all of which we believe can deliver long-term successful investment returns. Not only that, but they contribute to our mission here at Stride Wealth Management, which is to manage life's most important asset, your peace of mind.